Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Louis, and I'm excited to share today's episode with you. We're starting off with a story that's been making waves in the financial sector, the $95 billion rout of bank stocks. Yes, you heard that right, $95 billion. This massive loss in market value has been attributed to various macroeconomic risks, including the Reserve Bank of India's defense of a record-low rupee, which has constrained its ability to inject liquidity and tightened financial conditions. As a result, global investors have withdrawn a record 327 billion rupees from shares of financial services companies, with the Nifty Bank Index narrowly avoiding a bear market. This has raised concerns about the outlook for India's 4.5 trillion stock market, given that banks account for nearly a third of the benchmark index. On one hand, some analysts point to improving valuation multiples for bank stocks and India's long-term economic growth as reasons to be optimistic. Citibank Inc., for example, is prioritizing private sector banks over state-run lenders, betting that they can better absorb the macroeconomic stress. On the other hand, others warn that banks could face significant losses from unwinding their currency trades due to central bank diktats, and that net interest margins may shrink as tighter financial conditions weigh on lenders. Fitch Ratings estimates that this could potentially undershoot their 3.1% forecast for the year ending March 2027. As we navigate this complex landscape, it's essential to consider multiple perspectives and stay informed about the latest developments. We'll continue to monitor the situation and provide you with timely updates and analysis to help you make sense of it all. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're continuing our discussion on the latest market trends and global events that are shaping the world of finance. Today, we're focusing on the ongoing conflict between Iran and the US and its impact on oil prices and the global economy. As we've been following the developments, it's clear that the situation is complex and multifaceted. On one hand, we have the US escalating threats against Iran, which has led to a surge in oil prices. Brent crude has pared gains of as much as 2.6% earlier Monday to rise 0.7% to trade just below $110 a barrel. This increase in oil prices is likely to have a ripple effect on the global economy, potentially cooling growth and pushing up already elevated inflation. On the other hand, we've seen reports of discussions between the US, Iran, and regional mediators about a potential 45-day ceasefire that could lead to a permanent end to the war. This has led to a modest rebound in Asian markets, with gains in Japan and South Korea exceeding 1.5%. The sentiment is cautiously optimistic, with investors hoping that a resolution to the conflict can be found soon. It's also worth noting that the fallout from the Iran war has rapidly darkened the economic outlook, making it tricky for investors to predict what's next. As one strategist noted, investors' focus will squarely be on military actions on both sides of the Persian Gulf and whether or not Hormuz vessel crossings can improve further despite these attacks. As we navigate this complex landscape, it's essential to remain informed and adapt to changing circumstances. We'll continue to monitor the situation and provide updates as more information becomes available. Welcome back to the Riskwiser Zone. As we wrap up today's show, I'd like to take a closer look at some of the recent commentary from Jim Cramer on various stocks. Now, I know some of our listeners might be thinking, Jim Cramer, isn't he just a TV personality with a lot of opinions? And you're right, he is. But love him or hate him, Cramer has been around the block a few times and often provides insightful analysis on the market. Recently, Cramer has been discussing several stocks, including Starbucks, Intel, and Apple. Let's start with Starbucks. Cramer has been a long-time defender of the coffee giant, and he's been impressed with CEO Brian Niccol's turnaround algorithm. According to Cramer, Niccol's plan involves closing underperforming stores and expanding into new markets, such as the Midwest. While we acknowledge the potential of SBUX as an investment, it's essential to remember that every stock comes with its own set of risks and rewards. Moving on to Intel, Cramer has been praising CEO Lip-Bu Tan for his handling of the company's balance sheet. With the stock up over 27% in the past year, it's clear that something is working. However, as Morgan Stanley pointed out, supply constraints could impact customer confidence in the foundry business. As always, it's crucial to do your own research and consider multiple perspectives before making any investment decisions. Now, I know some of our listeners might be thinking, but what about Apple? Well, we didn't discuss Apple today, but rest assured, we'll keep an eye on that stock as well. After all, as investors, it's essential to stay informed and up-to-date on market trends and news. As we conclude today's Riskwiser Zone, I want to remind our listeners to always approach the market with a critical eye. Don't take anyone's word for it, not even mine. Do your own research, consider multiple perspectives, and never invest more than you can afford to lose. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.